The average American pays over $530,000 in taxes over their lifetime. As a real estate investor, you can expect to pay a lot more if you don't have a thorough understanding of your taxes. They say the less you know about the tax code, the more you can expect to pay. That's why they make it 5,000 pages long. What's going on, guys? Ryan here, Director of Operations of Boselli Brothers Real Estate, and today we are going to nerd out about taxes. Why are taxes important? Tax planning allows you to reinvest the money that you would normally be sending to Uncle Sam back into your company and your investment properties. As an investor, having a bulletproof tax strategy is critical. In this video, we will explore all the tax considerations and the common deductions available to real estate investors. We will also dive into the common entities used to invest in real estate and the additional deductions that those entities provide. Whether you're an investor buying properties in your personal name or investing them through an entity, this video will equip you with the knowledge needed to make informed decisions and maximize your tax benefits. Quick disclaimer, guys, I am not a CPA or a tax attorney, so please consult with your own CPA and tax attorney before making any business, financial, or tax decisions. With that being said, let's get into it. Now, let's walk through all the real estate tax basics. It's important to understand the fundamentals of real estate taxation. Those go into two buckets: revenue and expenses. Your revenue is your income. This includes capital gains and rental income. Your rental income is any regular income produced by your rental property. This includes rent, parking spaces, laundry fees, and any other revenue made from your tenant or from that property. Capital gains are simply any profit made from the sale of a property or an investment. This includes proceeds from a flip project, wholesaling, etc. Next is expenses. Your main expenses are going to be your depreciation and your operating expenses. Your operating expenses are pretty simple. It's any expense incurred during the normal operation of that investment property. Repairs, maintenance, utilities, property management fees, lawn care, tree care, anything that happens at that property, at that lot that you need to take care of. Second, and the much more complex of the two, is your depreciation. Unlike stocks, real estate is a real tangible asset. These real tangible assets depreciate over time because they're exposed to weather, normal wear and tear from tenants, just wood rotting from termites, anything you can think of. Properties just degrade over time. Real estate investors are allowed to depreciate the value of their property over time, which allows them to deduct a portion of the property's cost as an expense on their tax returns. This can result in significant tax savings and increase in cash flow. The typical period something depreciates at is 27.5 years, but it depends largely on the item. I don't know why they came up with 27.5 years, but that's what it is. Another example of depreciation is your capital improvements, or CapEx. Real estate investors can capitalize improvements made to their properties, such as roofs, electrical, plumbing, etc. These are major renovations. These renovations are added to your cost basis of your property. This reduces your capital gains in the event that you sell your property. For this video, we will focus on optimizing your expenses or deductions you can take as a real estate investor. First, let's focus on some common deductions you have access to as a real estate investor. As long as they are legitimately for your business or company operations, there are several write-offs you can use to reduce your taxable income. Here are some of the most common ones. Mortgage interest. You can deduct the interest on the mortgage of the property you own. Property taxes. The taxes you pay on your real estate are typically deductible. Depreciation. As I mentioned before, you can deduct the cost of the depreciation of your asset over time. And repairs and maintenance. Expenses incurred for repairs and maintenance are generally deductible. Next, we're going to talk about ways to structure your company for maximum tax savings. Generally speaking, there's two main ways to structure your real estate business. Now, there's other ones like trusts and things like that, but we're going to focus on the main two, and those are LLCs and corporations. First, LLCs, or pass-through entities. Owning assets in LLCs, or limited liability companies, can allow investors to pass through expenses and income from their real estate properties into their personal tax returns. This can potentially reduce your personal taxes and simplify your tax reporting. LLCs are much more versatile for joint ventures or partnerships. Generally, LLCs are better for dealing with passive income or long-term holds through a rental property. Like I said before, they enable pass-through losses, so any expenses incurred to the investment property can be deducted from your personal tax. Remember, the LLC itself is not taxed, but instead the profit or loss gets passed through to its owners. Sometimes your expenses can exceed your revenue. This can happen for a variety of reasons, but let's just say you conducted a big rehab on one of your projects. That company's loss can now get passed on to you. The other common business structure you have as a real estate investor is a corporation. Setting up a corporation for your real estate investments can provide additional tax benefits. Corporations are typically better for dealing with active income, such as from flips or from wholesaling. This is because they allow for more expense write-offs in dealing with excessive profits. Unlike LLCs, corporations are subject to corporate tax rates and not personal income brackets. rates. There are several additional deductions you can take if your properties are owned in a corporation. These include salaries, benefits, meals and entertainment for your investors or vendors. Our personal favorite is a Section 280A exemption. This allows you, as the real estate investor, to rent out your personal dwelling to your company for up to 14 days a year. This is done to conduct normal business operations and meetings, and you can charge your corporation typical business venue rates of your area. There are also tax benefits available to both an LLC and a corporation. Some of these include professional services. Fees paid to your accountant, your attorney, or your property management company can also be deducted. Home office deductions. If you have a dedicated space in your home specifically used for your real estate business, you may qualify for a home office deduction. This can allow you to deduct a portion of your rent or your mortgage plus Wi-Fi or anything else you need to conduct your business operations in your dwelling. And travel expenses. If you need to go to or from a city to go view your properties, all of these are operational expenses of your business and can qualify for a deduction. This can also include any kind of meetups, real estate symposiums, or any other educational tools needed to help you succeed in your business. Guys, I can't say this enough. It is so crucial for you to work alongside tax professionals and advisors when conducting any real estate operations. They can save you thousands and thousands of dollars along the life of your projects. A good real estate CPA can provide expert guidance and help you navigate waters that are foreign to most people. There are so many complex tax laws, rules, and regulations that are always changing. And again, like I said at the beginning, these booklets are 5,000, 6,000 pages long of tax code. You don't want to be stuck memorizing every page of those. Pay a professional and make sure it's done right. In summary, understanding and implementing effective tax strategies can help you maximize your investment on your property. By taking advantage of tax deductions, depreciation, 1031 exchanges, and all the other tax saving strategies offered to real estate investors, you can optimize your investment performance and grow your wealth faster. And that's going to do it for this video, guys. Please like, comment, subscribe, smash that notification bell so you're alerted when we post a new video. Head to our website, BoselliBrothersRE.com. Subscribe to our newsletter for all things real estate and investing. As always, it is 100% free. Please help us reach as many people as possible so that we can help you avoid the same mistakes that we have made along the way. That's going to do it. Again, I'm Ryan, Boselli Brothers Real Estate. See you next time. What did I say? There was two main things, two setups. I in no way should be trusted. There's two main. These walls are thin. Depreciable.